Welcome back to Crypto Unlocked. I'm your host, Crypto Daryl. Every cycle in crypto starts the same way with noise, disbelief, euphoria, and eventually silence. That silence, that cold stillness that creeps in after months of chaos is what the market calls crypto winter. And every time it comes, it catches most people off guard because it never starts with an explosion, it starts with a whisper. A few red candles, some fading volume, one or two failed breakouts, then suddenly momentum feels different. Confidence fades and everyone starts asking the same question we're asking right now. Is this the beginning of crypto winter? To answer that, we've got to separate emotion from structure. Right now, Bitcoin is trading just above critical long-term support, hovering around levels that once looked untouchable. After reaching as high as 125,000 earlier this year, it now retraced toward the low 100,000 range, consolidating under key resistance and struggling to find new, fresh inflows. On the surface, that looks like a top, but markets don't move because of surface impressions. They move because of structure. And when you dig into a Bitcoin chart, you see something more nuanced than a clean collapse. You see a battle zone. Look at the weekly candles. We're still making higher lows on the macro time frame. Even though daily volatility has picked up, that means long-term structure isn't broken yet. The 50-week moving average, the one that usually separates bull trends from bear phases, is still holding a dynamic support. Volume is still declining, yes, but it's not capitulating. In technical terms, this looks more like distribution range than a full-scale reversal. Translation, whales are adjusting, not abandoning. Historically, crypto winter begins only after Bitcoin breaks below its 200-week moving average and stays there. That's the line between correction and collapse. In 2014, 2018, and 2022, when we broke that level, winter truly began. Long frozen stretches of sideways despair that wiped out leveraged traders and fair weather believers alike. As of now, we're still moving above that threshold. So no, technically speaking, we're not in the crypto winter just yet. But that doesn't mean that warning signs aren't there. Look at momentum indicators. RSI has rolled over from overbought territory, MACD on the weekly has crossed down, and volume profiles show declining demand at the highs. That tells us the uptrend is losing energy. Add in the macro picture, the Federal Reserve balancing rate cuts with inflation risk, the US-China trade tensions resurfacing, and ETFs temporarily pausing inflows, and you start to see why prices feel sluggish. It's not just the charts cooling, it's liquidity around it. This is where psychology kicks in. Every major cycle has three emotional stages: disbelief, euphoria, and now fatigue. Right now, the market's not euphoric anymore, it's fatigued. The same influencers who screamed 200K incoming a few months ago are quiet right now. Retail traders are hesitating. Search trends for Bitcoin are down, but ironically, that's exactly when accumulation begins for the next move. Crypto winners are built on apathy, not fear. So is this apathy the start of something deeper or just a pause before the next leg up? Let's look at the clues first. The first clue is volume divergence. When price moves sideways but on-chain accumulation increases, this means smart money is quietly absorbing supply. Data shows long-term holders, addresses holding BTC for over 6 months, have actually increased their balances since the last dip. That's not bear market behavior, that's preparation. The second clue is miner activity. During true winters, miners capitulate. They shut down rigs, sell reserves, and network hash rate falls sharply. Right now, hash rate remains near all-time highs, which suggests miners still believe profitability will return. And the third clue is institutional positioning. ETF inflows slowed, but they haven't reversed. The big players aren't exiting, they're just waiting. If we were truly entering winter, we'd see panic liquidation spiking, funding rates collapsing, altcoins bleeding uncontrollably, but instead, what we're seeing is a rotation in capital, moving from speculative assets back into the majors. Ethereum, Solana, and Quant have all cooled off relative to Bitcoin dominance, which typically happens during mid-cycle corrections, not end-of-cycle crashes. That's why as a trader, I'm not treating this as a winter, but as autumn. The leaves are turning, the air is cooler, but the ground hasn't frozen yet. Autumn is where you prepare, not panic. That means tightening risk management, reducing leverage, and focusing on real assets with fundamentals. For me, that still means Bitcoin as the anchor, Quant as the infrastructure play, and Tesla as my real-world innovation hedge. The reason why I like this simple mix, because Bitcoin survives every cycle, Quant thrives on interoperability, and Tesla stays relevant regardless of crypto weather. It's a triangle of conviction that balances volatility with vision. Now, let's talk about what would confirm crypto winter. There are three major warning signs that always appear before the deep freeze. First, Bitcoin loses its 200-week moving average and fails to reclaim it for multiple months. That's the market's way of saying the long-term faith broke. And secondly, altcoin dominance collapses to single digits while stablecoin dominance surges, meaning traders have stopped speculating altogether. Third, volume dies across the board, sentiment drops into despair, and headlines start calling crypto dead again. When those three signs align, you don't need to ask if the winter is here, you'll actually feel it. Until then, what we're in is more like a reset. The hype cycle is cooling, leverage is unwinding, and fundamentals are taking center stage again. That's healthy. Every major bull run needs a cool down phase to shake out greed before the next wave. The danger isn't the correction, it's letting fear convince you the cycle's over when it's just breathing. If you zoom out to the monthly chart, Bitcoin still looks astonishingly strong. The macro trend is intact. Each cycle's high becomes the next cycle's base, and this time is no different. Remember, in 2017, the peak was 20K. In 2020, that became support. In 2021, the top was 69K, and in 2024 to 2025, that zone turned into the floor. Now we're flirting with above 100,000. And even with the pullback, the long-term stair-step pattern remains bullish. That's not winter behavior, that's consolidation before another expansion. However, just because it's not winter does not mean it can't feel cold. Emotionally, markets always overshoot both directions. You'll see pessimism spike, influencers disappear, and volume dry up before the next move. That's where discipline matters the most. This is where traders either burn out or level up. If you can control your emotions in the chill, you can thrive when the heat returns. Here's how I'm playing it. I'm watching the 100K level as my psychological support. If Bitcoin stays above it with strong weekly closes, I stay fully confident in the macro uptrend. If it breaks below 95K with volume, I start treating it as a deeper correction phase and look for accumulation between 80 and 90,000. Those are my fear zones. These areas where emotion peaks but opportunity hides. And let's be real, if a winter does come, it's not the end, it's the beginning of the next accumulation era. Every bear market in crypto has been followed by exponential gains. The people who called it quits in 2015 missed 2017. The ones who disappeared in 2018 missed 2021. The ones who panicked in 2022 missed 2024's explosion. Winter isn't punishment, it's preparation. So is this the start of a crypto winter? Not yet. The ground's cooling, the market's slowing, but the core fire, adoption, development, and conviction is still burning. The frost is coming for the weekends, not for the believers. And when the thaw returns, those who stay patient will own the next narrative. For now, treat this like what it is, the season between extremes, a time to recalibrate, reaccumulate, and remind yourself why you're in it in the first place. Because whether it's Bitcoin, Quant, Solana, or even Tesla, the future still belongs to innovation. And innovation doesn't freeze. As we move through this cooling phase where emotion is fading and structure is being tested, this is exactly when having the right trading platform makes the biggest difference. When volatility slows and liquidity thins out, the worst thing you can deal with is slippage, lag, and poor execution. That's why I always trade on BTCC exchange. They have been around since 2011, which means it's seen every kind of market, from euphoric bull runs to deep crypto winners, and it's still here holding strong. That kind of longevity only comes from trust and reliability. Whether you're holding your Bitcoin long-term, taking short-term trades on Ethereum, or positioning for the next big move in XRP or Quant, BTCC gives you the deep liquidity, fast execution, and the kind of transparency that makes you feel in control no matter what the market's doing. And here's the best part I always share. When you use my link in the description, you'll get 10% off all trading fees permanently. That means more of your profits stay in your account and less goes to the exchange, which is always good. So as the market cools, keep your head clear, stay disciplined, and trade smarter with BTCC Exchange. Hit the link down below, grab your 10% discount, and make sure you're prepared for whatever the season brings. Thank you so much for viewing this week's video. I appreciate you, and I'll see you guys on the next week.